I think, okay, so I think we are live now, and we can start the session. So welcome to the Fast Food and Cafe Virtual Expo. We are here today to start the Rupee series, as we've called it. And talking to us today is Mihir Mehta, Senior Vice President at Ashika Capital, who's going to talk about the critical success factors for raising capital from institutional and non-institutional investors. And that's, I'm sure, a very interesting session that we are looking forward to, and all the F&B community is looking forward to, Mihir. So over to you. Let's start the session now.
Sure. Thank you, Minnie. Thanks for the kind introduction. Thanks for having me here. I always ask, am I audible? But I hope I am. In case I'm not, I'm sure you will tell me.
Yes, you are. Don't worry.
Okay, lovely. Thank you everyone for joining in, whoever has been able to join in. Generally, I've been told finance and things about finance can be boring, but I'll try to keep it as engaging and interesting as possible. So just to start off with, let me give you a quick introduction about us. It will not take more than 30 seconds, I promise. So as Ashika Capital, we are a boutique investment banking firm, part of a larger group with interests in stockbroking, lending, investment banking, wealth advisory, asset management. At a group level, we are a team of about 280, 300 odd people. And on the investment banking side, in the last 5 years, we've been successful in raising about $250 million plus for clients across consumer, real estate, healthcare, and BFSI, and food and beverage. Not because of only passion, but also because of I for passion for food. But I think interestingly, it's been an interesting journey to work with food and beverage players. One, because it's very tempting when you're working with them, so it's fun to look at investment decks that we receive from some of these F&B players and all of you with really mouth-watering pictures. And I think as a segment, F&B has evolved so much in the past few years that it's been interesting to see how the next 10 years of growth in this segment will be. So, Minnie had asked me to prepare a long presentation, which I'm very poor at. So I've kind of skipped that. I have a short presentation so that you just don't have to look at my boring face. I will have much more boring slides to show you. Just one second, guys. So just for everyone's information, I think this session is live, so please feel free to put in your questions on the Q&A box. This particular talk or workshop, or however you want to take it as, will not take more than about 20 minutes. So if there is any area that you would like me to focus on or talk a little bit more about, please put that in the Q&A box. The platform is slightly new to me, so I will leave that to Minnie and her team to take care of that. So, one of the things, the session was called Critical Success Factors for Raising Capital. Now, whether it's institutional or non-institutional investors alike, fundraising is an interesting exercise. And to be honest, it's like looking at the mirror, because It tells you a lot about your business from a third person's perspective. So, a lot of times, and in my last few years, I mean, last couple of years, I've been talking to business owners for whom fundraising is not really about raising capital. Obviously, that's the eventual goal of any fundraising exercise. But I think more than anything else, a fundraising exercise helps you discover a lot of attributes about your own business, being benchmarked against maybe the industry, maybe other businesses. And that's pretty interesting. So it allows you to also, I mean, yes, you kind of expose your business to someone else, but it allows them to view it very objectively and give you feedback that is not only going to be helpful in improving your business, but also in the long run, give you a reality check as to what are the things that you need to focus on, or, essentially where is the business going. Uh, so I love using pictures, by the way. I'm a big movie buff, so please bear with me at least for 10, 11 slides that I've put. So first things first, I think this is something that I keep telling my team here, and I keep telling business owners. So a lot of times I'm asked that, okay, why would now whether I look at a private equity investor or venture capitalist or even a family office, why would someone invest in the business? And I use this funny word which is moat. And people ask me, okay, what is moat really? I mean, why do you keep saying this? And and the first thing that I get is, look, dude, we are not from finance. Please keep all your jargons to yourself. There's no showing off here. So, ideally, when any, I mean, if, and again, during this workshop or talk, I mean, I would love for you to think like an investor so that you exactly know that what would be an investor's expectation from you as a business, you as an entrepreneur and the business. So the term economic moat, very clearly defined by or popularized by Warren Buffett, and I'll just read out the two lines which I mentioned here, which is it refers to a business's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share from competing firms. Very simply put, it's what we call and what a lot of F&B players call the secret sauce. I think it is the secret sauce. It is that secret sauce that would enable you to chart a growth trajectory, which will be over and above the industry, which will be guarding your market share, which will be enabling your profitability and your, sustainability in the industry. There's a reason today. I mean, I can't think of many examples, but I've always enjoyed. So in Bombay, there's this Parsi cafe which goes by the name Britannia. Now there's a way, and again, different dishes are made by a lot of Parsi cafes, but the way they make their, so they have this berry pulao that they make. It's very interesting to eat only from Britannia, and that's why it has garnered the kind of brand equity, the kind of customer recall that it has, because there's some secret sauce. There's something that enables Britannia to deliver that product flawlessly every single time. Even in business, there needs to be that secret sauce which will allow you to maintain your competitive advantage over your competitors. The idea, what I'm trying to tell you, is that it's very important that when you're talking to investors or when you're even thinking of raising capital, first things first, what is that moat? What is it that you are, I wouldn't say necessarily doing differently, but maybe even doing the same thing, but in a much better manner that allows you that competitive advantage. So it's important that you discover it, you analyze it, that is it really better? How will it bring me that additional growth, or how will it ensure that my market share is guarded, and so on and so forth. And the last part is again very critical. You have to communicate it. A lot of times, I personally see it's not just about investment decks, but when I ask about businesses as to why should someone even think of putting money, we talk about multiple things that, okay, we have these many customers, we have these many, this is our repeat rate, or so on and so forth. Those are, again, data points. So it's like saying, okay, those are the effects of something that you're doing right. What is it that you're doing right? And why is it going to be giving you that edge? So this is very important, guys. I think, establishing moat is extremely critical. Now, why is moat so important? As it rightly says, you can't expect extraordinary results with ordinary effort. See, when you're trying to raise capital, obviously, as an investor, if I were an investor, my entire agenda of investing capital is eventually to make an attractive or to build an attractive return profile for myself and maybe for people who I have, whose funds I'm managing. Uh, Now, if you were doing everything in an ordinary manner, how are you going to generate results that are extraordinary? Today, before Jubilant revolutionized the entire distribution channel and created a fantastic business model in terms of distribution, I'm sure there were other pizza sellers and there were a lot of players who were selling pizzas across the country in maybe pockets. Now they came in and there was a tremendous amount of effort in doing that distribution better and in a way which was different than some of the players who were already in the industry. So I think it is important to create that I would say I wouldn't call it a barrier really, but I would call it something that maintains a competitive advantage. And this is important because this is what is going to let you or enable you to grow better than industry, better than your peers maybe, and guard that for a certain horizon or certain time period. In F&B, I mean, so a lot of times actually, again, this comes to me often. I've not named the pictures, but I'll go through it. But I get this often that, what is my moat or what could be my moat? I mean, I'm doing this F&B business. I'm running a restaurant. I'm running 5 restaurants. What next? I mean, how do I convey or how do I discover my moat? So I think, as I said, the first part is you know your strength the best. So eventually your strength becomes a moat, but there's a difference. Strength is something that you possess. Moat is something that is the strength which enables you to generate better results, again, than the peers or than the industry. Now, it could be anything. It could be, as it says, the cuisine, the distribution, supply chain, the team itself. Um, Idea here is, so today, for instance, if I could take this example, so again, I think I really love what Wow Momos has built as a business. And being from Calcutta, and though not in Calcutta any longer, being from Calcutta, I've always been a fan of momos. And momos as a dish has existed in the unorganized setting for the longest time. I think right from northeast to east, even in north, momos are a very, I would say, a very regular culinary pick. However, what Wabomos did was they organized it, they made it into a seamless distribution business model, right? Allowing standardization, allowing certain benefits to come in, and with a certain, experience delivered while you're eating momos. Now they established the moat as amazing, as I said, of a good distribution strategy, and eventually building on it to create more products and create a pipeline. So it is essential that when you're trying to reach out to investors, you define your moat, and something that allows you, as I again said, and I'm repeating this point, is because eventually you may think that, okay, I have a great team. Now, not to be harsh, but to be honest, someone else may also have a chef and a trained chef on their team. But okay, this is why your team will allow you, and this team will enable you to achieve, uh, you know, extraordinary results in the long term, say whatever, like 5 to 7 years, or even longer than that. So that's where you need to analyze that the mode that you're communicating is actually a moat, and it's not just a strength which some other business or some other peer may also possess. So this is critical when you're reaching out to investors. I think this is the first step. Even before you start reaching out, I would suggest that as a team within your team, now whether you're running 5 restaurants or 10 or one, it's important that you deliberate and you discuss as to why would someone invest, and this is what the moat of this brand or this entity is. Once you have figured that out, you will be much more confident and sorted when you're reaching out to investors. This is again extremely critical, and I think a lot of times we see when you're trying to get in an investor, when you're trying to raise capital, what companies should understand, founders should understand is what kind of investor are you really seeking? Because with every type of investor or with different types of investors, the expectations are different. The reason is not, so sometimes we do get these queries that, okay, look, what kind of investor are you? I don't want, too much interference in the way I run my business. Okay, I don't want someone to, be very, I would say, pressure us for returns or pressure us to grow in a certain manner. Now, all this while, when you're seeking an investor, you are thinking of what your expectations are from that investor. You are thinking that I do not want an investor who tells me to do this or this. I don't want someone interfering in the way I run my business. I do not want to give out too much control, things like that. Let's transcend from that thought process once, especially when you're raising capital or when you're trying to raise capital, is that once you have figured that, okay, this is the kind of investor he or she is, or this is the kind of investor this particular fund is or firm is, you need to then understand what their expectations would be and then map it to your own expectations if they match or don't. And that is where, and also there's, eventually these two categories there may be certain subdomains, but just to focus on strategic versus financial, or even it could be a blend of both these kind of investors, it is crucial that your pitch or the way you're presenting your business, yourself, is tailored as per the investor you're speaking to. Because both of these kinds of investors, or these, I would say, the idea of these investors will be different, the expectations will be different, the thoughts will be different. Just to very superficially summarize, and I'm just going to hold this slide for a few seconds or maybe over a minute, is to tell you that what would be the expectation of these investors broadly. Again, yeah, see, fundraising is not a very scientific exercise per se, right? You're meeting, you're talking to multiple individuals, firms, they have their own investment thesis, and so on and so forth. But this is just to give you a broad idea as to what would ideally, and in an ideal scenario, a financial investor would think like, and what would ideally a strategic and not essentially like, an investor who's just pooling in capital would think like. And this is where, if you understand very clearly that, okay, the investor or the firm I'm going to right now, this is how, the firm would, or this is what they're in. And generally see investors are forthcoming in kind of putting out their investment thesis or putting out their thought process as to when they invest, what do they look for, what are their expectations, so that you can tailor your pitch, and you can actually understand, okay, this is what this person would be expecting. And also you need to be able to internalize it so as to ensure that you will be able to deliver what they might be expecting. So just from a financial investor's perspective, because any a financial investor, and whether it be a venture capital firm, private equity firm, they would be keen. The reason they are investing is because for them it is an asset class, as it rightly says towards the end, that it's an asset class. So they are investing because eventually they need a return profile. In slightly harsher terms, they need the money back. Obviously, they bring in a lot of synergies, whether it be from board level perspective or streamlining operations and so on and so forth. But eventually, they need to look at what kind of return profile are they going to get if they invest in this asset class. And because they're going to take some risk by investing in you, and it's an equity investment or however it is, um, it may bust and it may go bust, sorry. And then what? So things like that. So they're taking a risk for which they seek rewards. Now here, some of the like one of the very critical attributes is exit is extremely critical, or exit potential, or how will I exit or we exit from this business is going to be critical for a financial investor. Now, whether you put it in your pitch or not, this is something that you need to understand, that they would love to understand. How will they be able to exit your business in the next 5 or 7 years or 3 years, even whatever exit tenure or horizon period that they are looking at? Because their capital is time bound, right? So they are again investing capital where either they might have raised capital from other investors in which they are managing, or even if it's their capital, they are actually bearing the opportunity cost of not investing that capital somewhere else. So it's like how we say it, right? Today, if you were to use your um, say house as an office, an empty house as an office, in fact, just from an accounting perspective, we also, I mean, a lot of times I see that ओके ये मेरा घर था, ये मैं इसको ऑफिस की तरह यूज कर रहा हूँ, तो इसमें मेरा कोई रेंट नहीं लग रहा. बट if this house was rented somewhere else, right, you would make an income. So same way, if I were investing in a business, I am actually either pulling that capital out of somewhere else where I could invest, or it is someone's capital that I'm paying some kind of financial cost for. So if it's not time bound, or there's no exit potential, then it's in some ways or the other equal to charity, but that's not what I'm in the business for. So it's important, really, for anyone, whether F&B, non-F&B, for you to appreciate that they're in the business of investing. So you need to acclimatize them with the exit potential. Now, each business, if it's a restaurant business purely, the exit potential may be different as compared to a cloud kitchen like a cloud kitchen centric business as compared to a QSR business. The exit potential may differ, the exit valuations may differ, and so on and so forth. But you as an entrepreneur need to understand this and have this at the back of your mind. Now, financial investors can be purely financial investors, which essentially who invest capital in a time-bound manner and look at exit potential. One of the other investor classes under financial investors are non-strategic family offices. So this basically implies currently there are family offices who started investing in directly in startups and in businesses within their portfolio. The advantages that ensue when you're raising capital from a family office ideally is that while they look for, obviously, that exit is critical to them and even the horizon period is critical, but it is slightly more stable because as I mentioned, they may not be purely in the business of investing. So for them, it is about supporting an entrepreneur, supporting the business. And if it's a family office that itself is amassing its or utilizing the wealth that is coming from businesses, they understand the life cycle of a business from that perspective. So yes, I mean, family office capital is slightly more stable and comes with those certain insights also. But again, the bottom line is there has to be an attractive return profile, and it is going to be looked at as a business. When it comes to strategic investors, again, the difference is the idea is to expand or enhance business and eventually enhance their own value. So today, for a strategic investor, it's not just going to be about key, okay, I'm investing in this business, 5 साल में मुझे exit चाहिए, मैं निकल जाऊंगा. Not really. The idea is how can I, in fact, their vision is more or less oriented towards integrating the business to their own business. So as it rightly says, to the last point says that the long-term roadmap of the business and like the critical aspect is integration. How could this business and us getting into this business enhance our value? How would our investors look at it if there are investors? and things like that. So for a strategic investor, again, what they need to look at when they're looking at your business is like, common factors or areas where they could explore synergies, areas where they could add value, and so on and so forth. Like just a very, I would say, quick example, like it may be so that, and you should implore upon it. When InfoEdge had invested in Zomato as a platform, that was more like a strategic investment, but because they could see some strategic alignment that, okay, this is where we could explore synergies or this is where we could add value. So their idea is completely different, and hence their expectations are different when they are looking at a business. And they will be more involved, I'm sure, in the business, because eventual idea, as I said, is to integrate businesses, integrate teams. And obviously, as you would understand and appreciate, integrating business is more than just integrating, like, that, okay, this is the business you're doing, let our team manage it. No, it doesn't happen like that. It's integration of teams, integration of vision, integration of multiple other things that happens when a strategic investor comes in. So this is very critical. Sorry for spending a little bit extra time. Sorry if it got boring. You can please get your coffee. I don't need to tell you guys. Most of us are, from the industry. So, uh, but it's clear. It's important, rather. Sorry, to understand clearly as to what kind of investors are you approaching. Know what their expectations would be, and then, you know assess whether you would be a right fit or not. So I think, again, from an investor's perspective, this is the most critical aspect. Uh, Many a times and as founders or as entrepreneurs, we are focused on how do I make them enter my business, and that will be their decision, obviously. On the other side, they are thinking, how will I exit this business? So I think as founders, this needs to be very clear to someone that eventually it's not going to be about what, I mean, yes, they are entering for a particular mode that you have established or for a particular thing that they see in your business. But once they've entered the business, once they've pooled in that capital, once you're utilizing that capital, what next? The next thing is, okay, this is what, or this is how I can exit your business. Now, this is very critical because eventually, if it's a financial investor, now if I've invested, say, whatever, like X capital into your business, and I'm looking at an X plus plus after 3 years or 5 years or after 2 years, it will all be only on paper if there's no real exit potential. Now, notional value gains don't really give you wealth, or notional value gains is basically paper gains, right? So today, just to give you an example, I mean, if today I enter your business at a 100 rupee value, 2 years hence it may be a 200 rupee value because you've grown your revenues, you've grown your beta, you've grown your operation scale of operations. But what next? It can even go to 300. But am I realizing it? If I'm not really realizing it, and if there is limited potential to realize it, trust me, investors will be wary to enter a business. Um, so as I said, somewhere or the other, whether you're pitching or while you are talking to investors, please know this very clearly that it'll be critical, for them to look at the existing, potential, as well as how will they exit the business rather. So I would not really recommend that you put it as a part of your pitch, but this is something that needs to be charted by you, so that they are not in limbo as to where will I make my money. Now, this is very crucial, and I think a lot of times when you're, going out to raise capital or setting out to raise capital, the thing is that, guys, even there, I mean, today, any investor that you're approaching, he's investing for a purpose. Obviously, he loves your business, or he or she loves your business, and the fund is happy that, okay, this business brings in that moat. But the idea is that we need to prepare for, eventually exiting this business. And that's where again, whether you put it in your pitch or whether you do not put it in your pitch, it's important that you do some sort of scenario planning. What is going to happen to this business 3 years hence? Also, here, I would just spend a couple of, rather 20 to 30 seconds to tell you that when you are determining what would happen after 3 years, please know that you should determine all possible scenarios. Normally, what we see is that, okay, look, I'm going to achieve X percentage of growth and I'm going to land up here. But what if you don't? What's the downside? And if there's a downside, what would ideally an investor possibly make on exit valuation? If you have this sorted in your head, you kind of also know, okay, if this is the risk parameter involved, this is the potential valuation I could get today. In my next, I think, my next session, I'm going to talk about more about value and valuation. But um, when you're arriving at your present valuation, it's important that you also consider an investor's thought process when he or she is looking at the exit valuation. Now, whether it's an institutional investor, like as I said, a private equity fund or a venture capital fund, or even a non-institutional investor, it's important to do this because it gives you a sense of where if my business does not reach its like today, obviously, I mean, maybe 6 to 8 months back, no one thought that this would be the scenario we would be in, and it has reset expectations largely and across the board. And you know, that's business. So you may encounter industry level scenarios. You may encounter like this is obviously a black swan event, but there may be multiple things. I mean, I remember I was working with a liquor company, and suddenly they wanted to get into contract manufacturing. So they were trying to bottle beer in someone else's facility. Yeah. So when they were making their plans, they said, okay, look, this is how we'll make it, and this is how we'll sell it, and these are the number of cases that we'll hit, per month after a year or after a couple of years. Incidentally and unfortunately, what happened was that when they inked the agreement, you know, with the bottler, there was no requirement of minimum guarantees. But when they started processing, as I said again, unfortunately, things became tough physically, and so the bottler actually sealed the factory and said that, look, if you want to manufacture here, you have to give me a minimum guarantee, and the business was in a fix because obviously it would have ramped up to a certain level, but they were not in a position to give minimum guarantees to the bottler for a particular number of cases. Now, scenarios like that keep happening. It's very difficult for you to fathom, uh, okay, this is what is going to happen to your business. But what you can do is, if I am estimating that I would reach 100 crore at the end of 5 years or 3 years, whatever it is, what if I don't? And if I don't, what could be my, realistic scenario? What could be a pessimistic scenario as well? Now comes the second part to this. You kind of, once you've arrived at your possible exit valuations, you also need to benchmark what kind of return profile are you creating for your investor. See, we always think of, okay, as I again said, if you think like an investor, you would understand that their risks are, if I'm investing in this business, I'm taking a massive risk because if the business does not perform as expected, this is where I would land at. Now, if I was thinking that the business would reach a particular X level, but if it does not and it just stays at X minus minus, at X minus minus, this is what I would make for my stake today. Is it enough attractive? Maybe or maybe not. There are other asset classes which are less riskier, which maybe, give you more visibility, have lesser risk. Like today, just to give you a quick example, if I don't see myself making a reasonably, high IRR, today's public markets, where there are listed entities, financials are visible, large entities, and if they can make me 10-12% a year, what is my incentive to assume a higher risk? So the idea really is that when you start benchmarking these possible exit valuations, you yourself as a founder understand that, okay, this is what even I would end up at or end up with, and this is what my investor would end up with, does this make it attractive for him or her? If it doesn't, you're going to go back to the drawing board. So I suggest that you rather do this exercise before you reach out, so that you have all your scenarios charted out. Because once you reach out, and there's a lot of thesis or in time that that investor will put in, and eventually to realize that no, it doesn't make sense, it may turn out to be a futile exercise. So this is very critical, you know, even before you kind of set out to raise capital. Is the last thing, guys. So tweaking the communication and tweaking the not just the communication. I mean, I would rather say it's a wrong term, but tweaking your entire thought process and your business plan. Course correction is extremely important. See, fundraising is a evolving exercise, and when you're raising capital, you gotta be open to that thought process that it'll evolve. Um, you know, there was a quote that once a gentleman had told me, and it's actually a pretty famous one. It says, "Beauty lies in the eyes of the beholder." So, idea here is that today I may think that I am worth X, Y, Z, but or I can achieve this, or I can do this. But once I am out in the market, once I'm meeting different investors, they may hold a different perspective. Some perspectives may be right, some perspectives may be out of way. But the idea here is, if you have done what I was just mentioning previously, and if you are confident that even if I've done my scenario analysis, I understand that if the business does not perform as expected, this is where we would end at. There is a potential to exit, and so on and so forth. Honestly, if you have factored in those things, you would be able to answer an investor better, and he would be more comfortable, he or she would be more comfortable understanding that, okay, this is what may happen, and even if this happens, this is what my hedge is. So it is important that you keep correcting course based on the feedback that you've received, as well as based on your internal deliberation, and benchmarking yourself, the return profile that you are creating against some of the players who either raised funding or build a business, even if without funding, how they build the business. So that is, I think, that is extremely critical. This is something that I always keep. I mean, even I get very glad when it's over. But coming back to this, I think these are some of the thoughts. Again, the idea of this session was not to be too technical, but just keeping a very open mind and telling you, when you're raising capital, please think of your investor, and that will definitely help you, structure it better. Back to you, Minnie.
Yeah, thanks so much, Mihir. I think you got some really interesting points out there, and which I think some of us know, but you need to deliberate upon to understand it better and to think. And that is what I think you have made us do. Now, let me see. I can see a question from one of the viewers here. Let me read that out to you. The person asks, what can be the moat of a business which is in early stage or pivoting to a different channel where there are no data to prove the success of the business or the new channel? So what do you have to say to that? Do you want me to read it out again?
No, I got it, Minnie. Thank you. So, to whoever asked this, it's an interesting question, because when you are okay, so when you are early stage and when you're doing something which is unique and there is no previously recorded or previously established thesis, it is crucial that you understand that. So, like, let me give you an example. So I had invested in a startup which started out doing a different cuisine altogether. So that cuisine was largely not explored at a more organized level. Now we were completely unaware as to how would that cuisine do, because there was no proven history of how many customers would love that cuisine, how many would we even get repeats, or would people even like those items. There were new items even to me, and maybe and we ran a very small survey with our customers, and they said, look, I don't know. I mean, whether would I go out for a meal like that? So now what we did was, we still found a parallel. And please note that you would always find a parallel, if not in the same, segment, but it could be a different segment. So because this was a new cuisine, we started studying models of Rajdhani. We studied model of a soda bottle opener wala, and so on and so forth. So the idea was, okay, Rajdhani really came in and cracked the cuisine back in the day, which was, Rajasthani cuisine. Not everyone was aware of how Rajasthanis eat, dine, what's the experience like, and so on and so forth. So we started getting in a lot of insights from there as to how did they pivot, what were the mistakes that they made. We looked at soda bottle opener wala again, which organized the Parsi cuisine, and it was interesting because I mean, again, I think we were not aware as to how our cuisine. Now, to be honest, does it give us answers in terms of that, you know could this be the moat? I mean, ideally, yes, if it's something unique. It's just to say that you have to find certain parallel data points or certain parallel studies which allow you to, say that, okay, this could be a mode because this has been, it may not be in my particular domain, but it has been done before. So, so things like that, right? Uh, so what I would suggest is that try and find parallels. You can establish it as a mode, so it can be anything.
Just a second, Mihir, I think we went offline for a bit. So if you could just repeat that answer again, because I think we did go a
Okay.
bit offline.
Okay, my bad. Sorry. So what I was just trying to say was via an example that I had. So I had invested in a business which is doing a completely new cuisine. And so because it was asked that more for an early stage or a business pivoting to another channel. So if you are certain that, okay, this is not, and you may not have data previously to back your thesis that, okay, this will do extremely well or this will do okayish well or however it will pan out in the next 3 to 5 years. My point essentially was to find parallels. So when we were working on this business study, and this was a completely new cuisine, had never been experimented with before, we took from case studies of Rajdhani, we took from case studies of soda bottle opener wala because they kind of organized a cuisine which existed. I mean, obviously
Right.
Rajasthani as a cuisine existed, but on an
Right.
organized level, maybe not. It was a very home chef or a very home driven thing. Now, Rajdhani took that concept, created some experience, and built it out. So we said,
Right.
okay, there is a parallel. So why it can be my moat is because there is a parallel which has been done in some other cuisine. Same way with
Right.
soda bottle, we said, okay, look, Parsi cuisine, very limited. There are very, single Parsi cafes. I mean,
Yeah,
today there is
that's
no
true.
one like Britannia. There's no Britannia 2. There's no Kiani 2. There's no, like, but soda bottle opener wala 1, 2, 3, 4 expanded. So that's
Right.
the thing. So there was history, and we said, look, yes, this can be my mode because this is what, there is a parallel to it. So I think that's what I would say to that.
Right. Right. Now, I found one of the points that you said quite interesting, where you said that usually a founder would be thinking about what he or she is wanting from an investor, how much of interference, and like when you talked about the financial or the strategic investor, right?
Yeah.
So I wanted to understand that where do you think personally, how do you draw up that balance of a founder's expectations vis-a-vis the investor's expectations? Like, if I can explain a little more, it's like any relationship, right? So how much
Yeah.
do you give, how much do you take, how much are you ready to give up on your expectations, if I can put it like that? So when it comes to business, what do you think?
So I think, many, to be very honest, and this is what I should say. Like today, if you're driving a car, and when you are driving a car and you've
Mhm.
given your shotgun the maps, Google Maps uske haath mein hai. Now you have an innate
Yeah.
sense of driving and the road direction, right? But you still have someone who may be advising you
True.
on the side, right? He may be like, okay, यहाँ से
Yeah.
right, but now you may know कि यार ये right से थोड़ा लंबा पड़ेगा. Let me take this other right instead, and you may
Right.
take it. See, the
Right.
idea here is you have to appreciate. So sometimes what I encounter is that, so sometimes when founders tell me I don't want interference, and I ask them, why would someone interfere? Because today, like when I look at a financial investor, let's take an example of a venture capital fund or someone who has 15 portfolio companies. He's looking at 15 portfolio companies. So today, if he has to
Right.
interfere, and which honestly I feel is a wrong word to use, because No one wants to interfere. Eventually, see, it's like saying, as you rightly said, in any relationship or in anything, you are all in together. So,
Right.
once I was told I won't name the founder. Now, it may be a little bit of theatrics there, but he told me a very interesting thing, and he today runs a large entity in the healthcare space. And he says that
Uh-huh.
when I was raising capital, and I was presented with a large, like a 80-90 page shareholders agreement
Uh-huh.
by the fund.
Mm-hmm.
And my lawyers were debating, yaar, ye, not this clause is, and multiple things. And he
Obviously,
told me,
yeah.
yeah, he told me that I just went in, like after a couple of email exchanges, I just said, I'm ready to sign it. And the fund asked
Right.
the entrepreneur that, don't you want to, like, go through it completely? What are you signing up for? And he says,
Mm-hmm.
look, you're taking a bet on me. Okay. You're investing in equity. You're not like a bank who's giving me money. I have to pay interest
Just
cost and I have to repay back. Obviously, I have
correct.
to repay and it's an obligation. But if I win and if my thesis is right, why will you go against me? Okay. So both of us will
Fair
go,
point.
I mean,
Yeah.
if I lose in a strategy, I anyways will then do things after discussion with you. But if I am saying the right thing, what are you going to achieve out of going against me? Unless there's I mean, generally you won't have an ulterior motive, because eventually if I do it right and I reach that mark of getting a valuation, which is like whatever valuation we are dreaming of, both of us will make
Yeah.
money out of it.
Then
So
absolutely.
I think eventually, yes, both founders and investors do give up, but founders need to keep in mind that investors are not going to sabotage business operations. They're not going to interfere
Obviously.
unless they, yes, see, eventually it's always good to have a sounding board. So if as a founder you're not really keen to have a sounding board, I do not think, I mean, you will have to recalibrate whether you're ready for investments, because if someone is giving you that
Right.
capital, obviously, I mean, today I may come back to you and say, look, I want to invest. Like today, if I'm a restaurateur and I want to start a cloud kitchen business, it's in fact better if I run it past you, right? You would give me
Right.
five other
Right.
insights which I may not know of, because again, I'm doing business as my own. So
Yeah. Fair enough.
yes, think of it as a sounding board, and eventually you will always be the founder is always the driver. No one ideally interfered, and you gotta drive. If you say that I'm gonna take that ride, you need to be confident. Ki haan, ye aap le rahe ho.
Oh, correct, correct.
That's
No,
it.
fair enough. Now we do have some more questions and we do have a little more time. So let me get on to the next one. An anonymous user here asks, how do you validate if the F&B business has the right product market fit, which is scalable? Do you look at any specific data points or metrics of those brands, and which are the most important data points for your validation? I
Okay,
think
so for
this will be something
personally,
that,
I think how I again product market fit, it's very critical. I think it's perfectly bang on, and so I would tell you on the number side as well as from what metrics that I use. So one of my critical metrics is something that I definitely say is repeat rates. How are customers repeating their purchases? Are they repeating it frequently? Are they coming in, and so on and so forth. So that is very crucial for me. One of the things that is again crucial is the organic reach. Today, with this entire digital first business
right.
customer acquisition, it's critical to understand how is my organic reach and how's my inorganic reach. Um, so basically, something to say that without marketing, what is the customer traction like, and with marketing spends, what is the customer traction like? Because it kind of tells you actually what your brand stands for. Because if you're giving too much, you know, I mean, if I'm adopting a lot of discounting strategies, it may abet behavior for a certain while, but it may not make it sustainable. I would also look at how my gross margins are, because that's again a very critical aspect when I am looking at a business. That do you have enough money left after you're selling that one unit of product or multiple units of product to run your corporate expenses, to run your marketing expenses, to run your own salaries, and so on and so forth. A lot of times I see that people doing products where gross margins are negligible, or not very exciting. So if yes, you may be, doing fancy products, but if it's not giving you enough gross margins, how are you going to, because when you scale, eventually, how are you going to meet your expenses? So
Right.
there should be enough meat there. Um, I said repeat rates. We also look at what kind of, the perspective of that customer is in the same space. So like, for instance, just to give a very quick example, if you're doing North Indian cuisine, I'm sure there may be five other players doing North Indian cuisine in a certain format. So look at how customers are perceiving your brand. Do they find the pricing too high? Do they not? See, if you're an Indian business, let me be very honest, we look at the value for money aspect, because eventually an Indian customer is looking at value for money. That does not mean you need to sell your, and again, I tell people I meet that it's not about selling your products cheap. No,
Right.
it may not be like, अच्छा मेरा product cheap होगा. No, आप जो product दे रहे हो उस पे do they find value for money? Do they find that, okay, if I'm paying X amount of money, am I getting that value? And Indian customers are value conscious, and we got to accept that and appreciate that.
Yeah.
I think these are quick parameters that I would look at to establish that, okay, yes, this business, and I would take about, 3 to 6 months of data to look at repeats, um,
Right.
and with marketing spends and with marketing spends, and how is the organic reach like?
Right. I hope the viewer has got a satisfactory answer. We'll take one last question, Mihir, and I think
Sure.
it is a very valid question, especially in these current times. Has an investor's perspective changed post-COVID, especially considering how the F&B industry has been affected? And if yes, what would they be looking at?
Yes, I think change drastically is my answer, because so a while back I was talking to one of the, a leading voice in the venture capitalist industry, and he told me a nice thing, that the company of pre 2020 and company of post 2020 has to look very different from an investor's lens. So yes, the perception has altered to things like, so earlier, yes, investors would chase growth, and everyone chases growth, but today growth with stability is important. So it's not that you burn all your capital and still generate growth. Eventually cash flow has to come in. Largely the focus is on unit economics, and are you doing positive unit economics, and are you going to be able to migrate that when you're scaling? So a lot of times what happens is that you may be unit positive. Like if I'm running one single restaurant, I may be unit positive, but when I make it 10 restaurants, I need a lot of stuff at the corporate level. Now I can't manage it. I need 50 other people.
Right.
So will I still be profitable? So do my unit economics sustain that, or support that rather? Um, yes. So from those aspects, the expectation is now tilting towards that. How do now? Yes, this was a black swan event, and this has reset a lot of expectations, because now what's going to happen, many, is that exit preferences, the way people are now going to exit, is going to change, and it has a ripple effect on how you're entering the business. So today, as an investor, if I know that my exit potential has changed and my exit numbers are going to change, I will obviously look at how am I entering this business, and that's where I think. And I mean, obviously, we are seeing how. I mean, I've been reading reports from Zomato and also talking to industry participants. I think one of the things that is evolving is how to build a more omni-channel business, so as to create natural hedge within the business. So, I wouldn't say that a cloud kitchen format is only preferable, and I'm talking specific to the F&B industry. I don't think it will just be that, okay, only a cloud kitchen is preferable, or only a dine-in model is preferable. If there are ways and means to sustain a certain level of brand ethos, as well as that experience the customer gets from your brand, it has to be omni-channel, whereby today, because we have been pushed. So because you mentioned Rashmi at the start of the event, I remember my conversation. I think we've been pushed to a time where we would have seen the cloud kitchen market in India grow to a certain size. We are seeing it happening maybe in the next 3 to 5 years, just because of this pandemic, and now people are ordering online. There's that comfort.
Right.
And that also as a space has evolved. Now you need to maintain certain standards, whether it be a Swiggy or a Zomato or however it is. So I think that aspect of, if possible, making it omni-channel to create a balance in the business, that if one vertical or one aspect is not doing that well, encounters a certain issue, you still have cushioning from some other business
Right.
vertical.
Right.
And I think that will be critical for investors to look at.
Right. And I think as you were mentioning, and what I think is very critical is innovation is the name of the game. So I think
Yeah,
that's what
absolutely.
uh,
I think
looking at.
everything is getting disrupted, and models as well as products.
Yeah.
I think we discussed about plant-based foods and plant-based protein. So we're seeing disruption across supply chain,
Right.
distribution, product,
Right.
everything. So you gotta keep up pace if you are looking to raise capital and
Yeah.
building that story, value-based story. So yeah.
Yeah. And I'm sure we will come out of it strong. We've got to end it on a positive note here.
Absolutely. Absolutely.
So thank you so much, Mihir, for today's session. And for all the viewers, let me tell you, this was part one of the two-part series. And a week from now, next Thursday, we'll be back with Mihir for a discussion on value versus valuation, which I'm sure would be very interesting as well. So thanks, Mihir, once again, and look forward to seeing you next week then.
Thank you, Minnie, and thank you, everyone. We'll definitely be back next week, and yeah, we'll be in touch.
Thank you.
Thank you, Minnie.